What's going on, everybody? It's Jeff here. Welcome back to the channel. I hope you all enjoyed spending time with family and friends over the holiday weekend. We have officially kicked off the last trading week of the year, and investors are eerily awaiting if a Santa rally is going to happen. I'm going to break down everything behind this, how it can affect certain sectors, and more importantly, what I am looking to get out of this, especially when it comes to small caps and AMC. I'm going to break everything down for you. Let's get right into it. As you can see so far today, we still have 2 hours left to the day, but all four sectors are green, with the tech sector leading. The small caps in your Russell 2000s are lagging behind the average, which is about 1% as of right now. So let's break down exactly what the Santa rally is. The Santa Claus rally is normally a seasonally strong time frame for stocks at the end of each year. It consists of the final 5 trading days of the current year and the first 2 sessions of the next year. The reason for this is twofold. One, you have a lot of retail like myself that could be selling off some positions, or what's known as tax loss harvesting before the close of the year. And you also have big funds doing a lot of portfolio rebalancing, whether that's adding to losing positions, adding new positions, closing profitable positions, and so forth. And a lot of time you get a good volatility throughout this entire week. Today was a little bit slow, especially when it comes to the small caps. We did have 2 runners. One was only pre-market, and the next one we played from about an hour into the day to about lunchtime. But more importantly, the Santa Claus rally. Here's what we really need to pay attention to, especially going into the next year. Now, we are about to close on the end of the second year of the bull run, and we have not had a correction in the S&P 500, which did just hit all-time highs. And we'll take a look at the SPY in just a moment. But considering the bear markets of 2000 and 2008 both took place after one of the rare instances that a Santa failed to show makes believers out of us. So this is a good indication for what could potentially happen next year if there is no quote-unquote Santa Claus rally. But here's what I'm looking at a little bit deeper, and we're going to take a look at the SPY charts. As I just said to you, it hit all-time highs, and you can see throughout this past year, it's been a consistent uptrend. The pattern has been beautiful, bouncing off the 50-day moving average. Had a little change here when we dipped down to the 100. Nice bullish divergence, ripped back up to highs, a little bit of choppiness. Was wondering if we were going to hit that double top, as you can see right here. And like I said, we bounced off that 100 moving average. And once again, like history, we hit all-time highs. But here's what I'm going to be looking at even closer. This is the IWM. This is the ETF for the Russell 2000. We have formed a very, very tight channel, just hanging around, bouncing from 210 to about 230. All right, now we did break below the 200 moving average, did bounce off the psychological 210 level, and now we're really trying to test both the 50 and 100 moving average. I'm going to zoom out for you. I'm going to also tell you why I'm excited for this. So as you can see, for a long time, we've really just been in consolidation. We had a little bit of breakout, I should say, in about the end of August to November, the early November of this year, before kind of falling back and staying right inside that channel. The reason why this is important is, like I said, look at AMC. All right, now charts are a little bit different, especially when you look back into June. But if you look right here, when we ripped from about $35 all the way to $46, that was in the same time frame, okay, when the IWM had its breakout. So I'm going to be focused more on trying to watch some of these small caps. Now, here is the other caveat to this. January is notorious for small caps to run. Now, not just like last year, where I'm going to be paying a close attention, as this is now the first year following the January short squeezes. Okay, and we saw the January, GameStop squeeze of last year, as well as a couple other stocks that did squeeze, not nearly as high, but they did, just to see how investors and traders are going to be watching this month specifically. Here is the other reason why January can be very good for small caps. I'm going to break this down for you, and I'm going to be completely honest. I had a good sized position in Wish, and I'll probably share the exact photo of it in prior videos, but my average going into this, I think was somewhere around like $6.50 or so forth. And after its latest earnings, which I knew was not going to be good, they had the CEO stating that it was going to resign as of February, but it just started to just downtrend and downtrend, and that $4 mark really became another form of resistance. And December 1st, I decided to cut my position at 356 at a $46,000 loss. And I did that in order to ensure the perfect time frame to not hold this for 30 days so I do not get stuck with a wash sale, so I can claim those losses against my capital gains in case I want to get back in on this play. And January is notorious for traders to do this. All right. They will hold their positions because it is at still, but they feel to be at a very, very low level, which I do think $3.50 is low for Wish. Now, I grant it, they have serious issues as a company. However, some of their logistics and intellectual property is very valuable. And when Gary Vee had posted this is the closest thing to an Amazon competitor, even though far away, still one of the closest things, and this was 2 years ago, the potential is there if the business decides to turn around. However, I felt like it was going to stay stagnant. And even if I did, let's say, buy back at 4, which I don't have any eyes or, indication of when I'm going to buy, back into this, if I'm going to buy back into this, still being able to take that loss, that $46,000 loss to offset my capital gains is a huge advantage to me, because that's always the worst when I bring my books to my mom come in March. She is a CPA and she does it for me. And she's like, Jeff, you didn't pay enough out of your quarterlies, and boom, it's just going to be a large bill with penalties. And I really don't like that to be happening. But this is notorious. And January becomes a time frame for stocks that not only are investors who got out of it for tax loss harvesting to get into, it's also a time for traders, okay, to look at stocks that have been beaten down, that could have actually been stayed, the price action has been, stayed down because of the tax loss harvesting, okay? So stay with me on this one. When you look at AMC sitting right here at just under $30, think about how many people, and if you've been riding with me for a long time, you know this, how many people wasn't a believer, all right, out of all the DD that we did, okay, all throughout all this time frame leading up to May, and they had purchased somewhere in the $60 price range. Well, we are currently 50% down from those highs, and over 50% from our, our yearly highs, as you can see, 72 right here. But there's a lot of action in the 60s. So there could be potentially those people that have gotten out of that positions on that same time frame, or maybe when it pulled down to the 50s, that will still see some of this consolidation happening. Wait for a reversal, wait for that uptrend to happen, and this inverse head and shoulders that's about to form on the daily right now, and look to take that to the upside. So this is just one of the key things I'm paying attention to, especially as the new month and the new year is ahead of us. So keep that in mind. Think this one over, rewatch this video if I was not able to explain it in such a clear facet. And like I said, guys, that is it for this one. I'll see you in the next one.